Hello everyone, I am Takeuchi, Representative Executive Officer. I'd like to thank you all for participating in this conference. There were numerous challenges in FY 2025, including supply chain disruptions due to the Noto Peninsula earthquake, a difficult business environment in China, and unexpected departure of our former CEO. Despite these headwinds, our business performance remained solid, driven by strong sales of EVIS X1 GI endoscopy system in North America throughout the year. Revenue achieved close to the forecast announced in February. Adjusted operating profit was 188.5 billion yen, and adjusted operating margin was 18.9%, both exceeding the forecasts. Our quality and regulatory transformation project, Elevate, is continuing to progress well to meet our commitments to the US FDA. We expect to complete all commitments to the FDA by the end of fiscal year 2026. Our three strategic guiding principles of patient safety and sustainability, innovation for growth, and productivity presented in our company strategy are progressing steadily. We made a great progress with Elevate, building a solid foundation and further strengthening our corporate culture to achieve quality management that truly prioritizes patient safety. For FY 2026, revenue is expected to grow steadily by 4% after FX adjustment. Adjusted OP is expected to be 175 billion yen with an adjusted operating margin of 17.5%. This is due to strategic investments to strengthen our organizational structure for future sustainable growth and improved profitability. The impact of US tariff policy is not included in our forecast due to the fluidity of the situation. We will continue to take measures to mitigate the impact while prioritizing the continuous provision of our products and services to the medical field. As for FY 2026 dividend, we plan to pay 30 yen per share, up 10 yen from the previous year. As a result of our transformation over the past few years, we have become a pure medtech player. Stable cash generation is expected. In light of this, we have decided to significantly increase the dividend level. We have also decided to undertake a share buyback of 50 billion yen. Finally, I am pleased to name Bob White, our new Representative Executive Officer, President and CEO, effective June 1st. In addition, Bob is a candidate for our BOD at Olympus General Meeting of Shareholders, scheduled to be held in June this year. I am confident that Bob's wealth of experience, exceptional leadership, and deep expertise in the medtech industry will help Olympus unlock its potential to cultivate innovation and drive further growth, befitting a global leader in the industry. Next, I will discuss the key strategies for each business segment for FY 2026. As explained at Q3 earnings call, from April, we realigned our divisional structure to be more efficient and patient and customer-centric. As part of this evolution, the ESD and the TSD transitioned into the new divisions of the Gastrointestinal Solutions Division, GIS, and the Surgical and Intervention Solutions Division, SIS. We will continue to invest mainly in three focus areas: GI, urology, and respiratory. First, in GIS, we are focusing on accelerating global market penetration and revenue growth with EVIS X1 GI endoscopy, as well as expanding intelligent endoscopy ecosystem with OLYSense, our new sub-brand for our primarily cloud-based integrated suite of endoscopic applications and solutions. In GI endoscopy, as part of phase 2 of the EVIS X1 US launch, we plan to launch a flagship monoscopes of the EVIS X1 GI endoscopy equipped with EDOF technology in FY 2026. But we work to shorten the lead time with the aim of bringing them to market as soon as possible. In emerging markets, we promote initiatives to expand the market share sustainably, while in China, we accelerate preparation for local production of GI endoscopy. We also drive the expansion of endoscopic ultrasound platform market. Additionally, we plan to launch the first CAD AI products of OLYSense in Europe and US. I will provide details later. In GI endotherapy, we continue to expand clinically differentiated product offerings in key areas of focus: ERCP, ESD, metal stent, and hemostasis devices. We aim to launch more than 10 new products regionally, including key markets of US, Europe, and Japan. In medical service, we are committed to delivering industry-leading services that meet customer needs in areas such as uptime, budget security, and operational support.
As noted earlier, expanding our intelligence endoscopy ecosystem with the OLYMY system platform is a key pillar of our GIS strategy. Let me walk you through what we focus on in the fiscal year 2026. The first and only sense the portfolio to launch will be a CAD AI software applications designed to detect, characterize, and analyze lesions in the upper and the lower GI tracts. Following that, the mixed 2025 CAD-E guidelines and recommendations from the ESGE, AGA, and BMJ, we are confident in our unique approach. Our AI-powered cloud-based design allows us to frequently improve the performance of our algorithms and continuously add new capabilities of the gastroenterologists. That AI polyp detection algorithm of the CAD-E was trained on the sessile serrated lesions, SSLS, and the large polyps that are open mist and are more likely to progress to cancer. Initial trial data shows OLYSense assisted the colonoscopies significantly improved that detection of the clinically relevant lesions without increasing unnecessary resections. Currently, the OLYSense Hub and the CAD AI products are being piloted in the selected US and the EU hospitals. They're receiving positive feedback at DDW and ESGE days. So I don't know that from the relevant events there. We anticipate the strong long-term potential enhancing customer engagement and recalling revenues and in the market share. That the phase of the rollout of OLYSense and the CAD AI begins and at the second half of this fiscal year 2026 with subscription model. Next, the SIS developed the endoscope, the laparoscopy, the basic ecosystem for the procedures in the urology, respiratory, and the surgery. To build the leading ecosystems, we will actively manage our portfolio and the scale major innovations into our core markets. In urology, we expand the leadership in the BPH through the iTine market development, while increasing the penetration of the core visualization and plasma technologies. I would like to introduce That's the solutive superposed laser system for urinary tract store management, which drives that lithotripsy, the growth. And the next slide. In respiratory, we continue to focus on the driving adoption of EVIS X1, the bronchoscopy, the platform, and the drive growth and the lung cancer diagnosis and the staging, with the stronger emphasis around the updated EVIS TBNA offering. In surgical endoscopy, we aim to introduce the Visera Elite 3 surgical endoscopy system in the US and China to improve market competitiveness. Among them, and today I would like to highlight the two products that we expect to be growth drivers for this fiscal year, along with the target diseases that we are focusing on. First, the urinary stones are a condition in which the substances contained in the urine crystallize for some reason and coalesce in the form of a stone. And the prevalence of the condition has been rising in recent years, with an estimated 40% of the patients experiencing the recurrence within 5 years. For that treatment of the urinary stones, we have a compelling and market-leading portfolio of the solutions. Olympus has the first company to launch now the new Cerium fiber lasers for the lithotripsy, and we command the top market share in this category for both the laser systems as well as the consumable fibers. The solutive superposed laser system is already available in the US and Europe and in APAC, and achieved double-digit growth in these regions during fiscal year 2025. We plan to launch the system in Japan and expect it to contribute further to our sales. Next, lung cancer. This is the disease with an estimated more than 4 million patients and the highest mortality rate among all cancers worldwide. When detected at an early stage, lung cancer is highly treatable by surgery. Our market-leading endobronchial ultrasound EVIS scope has contributed to and decided that the treatment policy by supporting the diagnosis of lung cancer type and the staging in combination with other diagnosis results. Our the slim EVIS scopes extended this capability to the peripheral regions of the lung, supporting visualization and real-time sampling of lymph node and lesion. We aim to launch the scopes in Europe, APAC, and Oceania, and in Japan in this fiscal year. And finally, I would like to briefly introduce our new CEO, Mr. Bob White. So that's in the medtech industry, and Mr. Bob White have been, and also for the globally and for the regionally, have the very good experience and expertise. And Mr. Bob White, and until April 24th, has worked as the executive vice president and the president of medical surgical portfolio for Medtronic. And before then, she was a senior vice president and president of Medtronic Asia Pacific, based in Singapore, where he had a responsibility for APAC as well as Japan. So that's why he has experience in Asia. And his proven track record spans the multinational organizations, as well as the entrepreneurial ventures in which he consistently delivered exceptional results. And Mr. White has seen the numerous innovation programs and also for that, and revitalizing Medtronic's respiratory and monitoring portfolios, advancing its GI portfolio, and spearheading its robotics program, and led to several R&D initiatives and M&A transactions to drive strategic growth and the value creation. His close engagement with the market and the customers has enabled him to maintain a strong understanding of the physician needs. Prior to joining Medtronic, Bob held leadership positions at the GE Healthcare and Merge Healthcare and the healthcare divisions of IBM. Throughout his career and in the medtech industry, he has played a pivotal role in improving the lives of patients around the world through that transformation of the healthcare delivery. I'm truly pleased that he is bringing his extensive industry knowledge and insights to Olympus with him. We aim to achieve sustainable growth and enhance the corporate value by continuing to deliver innovative medical value that only we can provide. Okay. And with that introduction, I would like to hand it over to the CFO, Mr. Andy Izumi, and who will lead you through our detailed financials for fiscal year 2025.
Hello everyone, I am Izumi, CFO. I would like to provide our consolidated financial results and business review for FY 2025. FY 2025 faced some challenges due to the external environment and others, but compared to the February forecasts, although the yen appreciated, the revenue achieved roughly the forecast level, and both operating profit and adjusted operating profit exceeded the forecasts. Consolidated revenue increased by 8% year-on-year to 997.3 billion yen, with weaker yen serving as a tailwind. Revenue reached a record high for both the single quarter and the full year. The revenue growth was driven by North America, which achieved double-digit growth in all three focus areas, GI, urology, and respiratory, led by sales of the EVIS X1 GI endoscopy system. On the other hand, in China, competitive environment has intensified due to the Buy China policy and others, resulting in the tough results for the full year. But Q4, we achieved a growth of 12% year-on-year. The business environment remains uncertain, but we will continue to closely monitor the situation and accelerate preparation for the local production in China. Operating profit increased year-on-year to 162.5 billion yen due to the decrease in losses related to Veran Medical Technologies, which were recorded in the previous fiscal year, and the tailwind from FX. Adjusted OP increased by 25% year-on-year to 188.5 billion yen, with an adjusted operating margin improving 2.6 points to 18.9%. Profit attributable to owners of the parent was 117.9 billion yen due to stable earnings base, with EPS of 103 yen. We plan to issue an year-end dividend for FY 2025 of 20 yen per share, up 2 yen year-on-year, unchanged from the forecast previously announced. Now let me look at each segment. First is the ESD. Revenue grew 8% year-on-year. Adjusted OP, excluding other income and expenses, increased year-on-year to 158.8 billion yen, with an adjusted operating margin of 25%, an improvement from the last fiscal year. Now looking at each subsegment in GI endoscopy, sales in North America grew 27%, led by strong sales of EVIS X1 GI endoscopy system. On the other hand, sales declined in China, with its competitive environment intensifying due to the impact of Buy China policy and others. In surgical endoscopy, sales decreased in China, while they increased in North America and APAC. Growth was driven by strong performance primarily in North America, led by new products associated with OR system integration. In medical service, we saw steady growth across all regions, especially in Europe and North America, due to stable revenue streams based on service contracts, including the maintenance service, and an increase in new accounts. Next, in Therapeutic Solutions Division, revenue grew 7% year-on-year. AOP, excluding other income and expenses, increased year-on-year to 69.8 billion, with an adjusted operating margin of 19.3%, an improvement similar to ESD. Moving on to the performance for each subsegment, all three focus areas, GI, endotherapy, urology, and respiratory, grew primarily in North America and Europe. In GI endotherapy, sales increased in HPV-related products and others. In urology, the growth was led by resection electrodes for BPH treatments and Soltive superpulse laser system for urinary tract strong management. In respiratory, we saw strong performance in the EVIS scopes, therapeutic devices mainly used for EVIS TBNA. Next is balance sheet at the end of March 25. Total assets decreased 101.4 billion yen from the end of previous fiscal year. The main reason for this was a decrease in cash and cash equivalents due to the share buyback and repayment of debts. Equity decreased slightly due to share buyback and dividend payouts, while an increase in profit was posted as a positive factor. The equity ratio rose to 52.5%, up 3.1 points from the end of the previous fiscal year.
Now, and the next, the status of cash flows at the first of the glance, the cash flow may appear to have decreased significantly because that the impact of the transfer of Evident was included in the last fiscal year, but the adjusted free cash flow and excluding extraordinary factors improved year on year. The cash flow from the operating activities was the positive one at 90.5 billion yen. It increases significantly year on year due to mainly to the increase in the profit before tax and corporate income tax refund. Cash flow from the investing activities were negative 65.5 billion yen due to mainly to the expenditures associated with the acquisition of tangible fixed assets and intangible assets. Free cash flow stood at the positive 125 billion yen. Adjusted free cash flow was positive 109.4 billion yen, excluding extraordinary factors such as acquisitions, transfers, and organization of the businesses. Cash flow from the finance activities were negative 112.5 billion yen due mainly to the share buybacks, that the payment of debts, that the redemption of corporate bonds, and the dividend payouts. As a result, cash and cash equivalents stood at 252.52 billion yen, up to at the end of March 2025. Next is that for the full year forecast for the fiscal year 2026. The FX assumptions that are the basis for the forecast are 145 yen to the US dollar and 161 yen to the euro, based on average rates in the past 1 month. Revenue is expected to be 999 billion yen on the par with the last year. The rate expected at the stable growth of 4% compared to the previous year after FX adjustment. Adjusted operating profits expected to be 175 billion yen with an adjusted operating margin of 17.5%, which show an increase in the long-term strategic investments such as R&D expenses for future growth. Profit attributable to owners of the parent is expected to be 105 billion yen with EPS of 94 yen. I will explain about the shareholder returns later. Note that these the forecast do not include the impact of U.S. tariff policies, as Mr. Takeuchi mentioned earlier, due to the fluidity of the situation. We will continue to closely monitor the situation and take measures to mitigate the impact. Next, the forecast by business segments. Let me just explain by each business segment by segment. NGIS, both revenue and profit are expected to increase after FX adjustment, driven by new products in EVIS X1 in North America, despite an increase in the long-term strategic investments such as R&D expenses for future growth. In SIS, both revenue and profits are expected to increase after FX adjustment, driven by the sales growth centered on the focus areas. Corporate expenses, such as the basic research included in the elimination and the corporate, have been reviewed. Starting from this fiscal year, a portion of these expenses are allocated to GIS and CIS. Lastly, let me just talk about the shareholder returns. Our capital allocation policy of prioritizing investment and growth drivers remains unchanged. However, we are happy to tell you that through corporate transformation over the past few years, we have become a pure medtech player, improving and stabilizing cash generation capabilities. In light of this situation, we have decided to significantly raise our dividend level. We plan to increase annual dividend by 10 yen per share compared to the last fiscal year to 30 yen per share for fiscal year 2026. Furthermore, as announced today, we decided on the share buyback of 50 billion yen after securing sufficient liquidity on hand for working capital and investments based on the capital allocation policies. This represents the 50 consecutive years of a share buyback. Going forward, we continue to prioritize business investments that enhance the shareholder values and allocate capital to ensure stable returns to shareholders. So we anticipated the business environments to remain uncertain this fiscal year, including U.S. tariff policies and the like. However, under the new management team that will be placed in June, we will work hard to achieve sustainable business growth. That's all my presentation. Thank you very much.
Thank you very much. Now I'd like to take questions. First question, the impact of the tariffs. You did not show that at all, so could you explain the reason? There have been some earnings call of the different companies, and I think each company make a decision whether to include it or not. And there are some qualitative guidance, but if you say that there's nothing is included in terms of the tariff, if you can talk about some qualitative impact. Of course, it is fluid. I understand that reason, but starting from April, the 10% tariff is already applied for the shipment from Japan. So concerning that, that is not included at all in the plan or forecast. Is that the case? Could you respond? Thank you for your question. Izumi, CFO, would like to answer that. Yoshihara-san, as you know very well, we have factories in the United States, and the products that we sell in the United States, most of them are manufactured mainly in Japan and other countries. So we do have an impact from tariffs. As of now, the impact probably will be about 20 billion yen in gross terms. And already, we have established a cross-functional team, sales, supply chain, and mainly the North American region. We are trying to take alleviate the measures to alleviate that. So most of the 20 billion can be alleviated. But how much would that be? We are not ready to say. And also the assumptions for the tariffs, as you saw in the negotiation between China and US, we don't know. So it's difficult to factor that in. So that's the reason why we did not include that. So to your question, the gross impact of 20 billion, and most of them can be alleviated, but we cannot say how much as of now. I see. So follow up one point. Detail 10%, 24%, so 20 billion, 90 days, 10%, and then 24% later on. Is that the assumption? Or your competitors, the peers and the Japanese companies and US peers, I think that you would use the inventory, and many companies said that the impact will occur from later on. So this 20 billion in gross, so is that for 9 months, and you said that that can be alleviated. So regardless of 10% or 24%, you can fully reflect that into the selling prices. Well, thank you. Well, first of all, our assumptions are that, for example, in Japan, 10% tariff continuing for 1 year. That is the assumption that we have before coming up with this 20 billion. Our inventories is usually for 2 months. So this impact will happen in June and onwards. As for the fact reflecting that into the selling prices, when you consider the impact on the medical the institutions, it would be very difficult for us to charge the extra right away. So we would like to take other measures, for example, improvement of the supply chain. So it's not going to be a simple reflection to our selling prices. We will take various measures. I see. Thank you.
I have 2 questions. And so first question is a cost. So this time, and when I look at the documents and so for that long-term strategic investments, so starting from that last quota, you have studied this strategic investments. So this means that, for example, about the 72% for that R&D expenses, it would be a little bit higher than the average of the medtech, including Japan. So that's what happens with that, about the proportion of this and percentage of the R&D expenses will be can be the strategic. So that's why I think that we should also maybe continue and this be sustainable, and also this is particularly higher in this R&D cost. So let me just talk. Let me ask about this, your prospect about R&D expenses in the near future. Okay, thank you very much. Okay, I'm Izumi, I'm CFO. I answer to your question. The basic idea is that we are on a mid and long-term basis. We needed to just invest for the R&D for that as a strategic investments. So therefore, this time and March 2026, so we increased the R&D expenses. This is not the one-time increase. So for example, and it's been difficult to get more specific about how much after the next year and onward. But anyway, it's not that we'll go down or go back down to that the previous level. That we at least we maintain the similar level, and also it can be increased further. So it's not that we just drop and get back to that level that's in sometime in the past. Okay, thank you very much. So let me just also about another follow-up questions about the cost in the past couple of years. So you are implementing the quality programs, and including for the dealing with the FDA requirements. How much of the cost of it this is? So this year it seems like that it will be just go down a little bit. What is your plan of a specific cost for this and elevate the quality assurance programs? And what happens after for it will be getting into for that, including the about this specific cost for the quality assurance will be included in also for the other the expenses. Okay, thank you very much. First of all, when it comes to the cost for Elevate in FY 2025, so this is a 11 billion yen for say, and the other cost is the 11s, and for the 30.5 billion yen as the total cost. But it'll be almost in line with our forecast and plan. In FY 2026, so it will be, I mentioned it will go down a little bit because, for example, that for other costs, it will be about 19.4 billion yen to that 10.1 billion yen, which will reduce to that level, and then for SGA, and 9.4 billion yen, and the total, and 19.9 billion yen. It will be below the 20 billion yen. This is a plan for this year. And go further in FY 2027, and the further is very difficult to talk so clearly, but this is the Elevate program. This quality program is a 3-year program, and so they will be ended this FY 2026, and that's also that no cost will be included in other costs. But after that, for the SG&A, but it's still that about the 10 billion yen of the cost will be included, but it's not that so dramatically go down. But when we try to make it as efficient as possible. Okay, understood. Thank you very much. That's all for me. Thank you.
The impact of the tariffs, I'd like to know more details. And you said that the cross-functional team was established and you're coming up with the different countermeasures. So more specifically, what kind of measures are being looked at? Could you give us some examples? Thank you. Well, it's difficult for us to talk about the details, but one thing is the supply chain optimization. So, for example, something that goes via US, some products will go to other regions, so sending them directly, and also the strategic price setting. It's difficult to reflect it to the prices, to adjust the prices or adjusting the discounts. And the inventory, the increase in July and onwards, if the tariffs would go up, the we would proactively increase the inventories in the United States. That's another thing that we are thinking about. Thank you. So follow-up question. So on the demand side, in U.S. market, the impact of the tariffs or new administration impact, endoscopy demand, would there be a risk that a demand would be impacted in your view? As of now, at least our numbers, the forecast, we do not include that impact. But the impact of the tariffs, if the economy as a whole goes through the stagflation or inflation and it worsens, even with the medical equipment, it could be impacted. So that is not factored in yet, but we need to closely watch what would happen. Thank you very much. That's all.
Yeah, so that let me just, I don't answer directly to that question, but probably many people are aware that at least when it comes to medical equipment, and since 1990s, both of the Japan and the US have offset the tariff with each other. So that's our basic rule since then. So that this meant, for example, that because that this is the medical equipment correlated to this, but the medical services for each of citizens for both countries, so that that basic rule will not change. So that for us, we're convinced that this is also to the governments, and also I think that the U.S. government will share the exactly same concept. So that basically that we strongly hope that the tariffs should be zero. So this is not so much on that our just business performance, but we would like to avoid any possibility that these medical services and practices will be hampered with this tariff. Okay, understood. Thank you very much. My question about your business in China. So when I look at your numbers, and it seems like they recovered substantially in your Q4, but until the end of Q3, that the business of about, for example, and the concentrated and the purchases, the China first policies, or that are the negative factors are there until the end of Q3 last year. So that's why. And currently, what is the current status of a business in China? I'd like to know about it, and also for last year. And it seems like the gross profit margin is better than your forecast. So, so that does mean that your recovery in the business in China last year was better than your forecast. So I'd like to know about a comment, please. Okay, thank you very much. First off, let me just answer to your question from me. So, for Q3, at the time we have the earnings call and the last time of February. So I will mention about we see that's the sign of recovery after getting into this fiscal year and this year. This means that so the December is the end of fiscal year and in China, and going towards the year end of the fiscal year, and so it seems like some of the stored and realize it that the demand have gushed out or just comes out, and that will lead to our incremental and and substantial recovery. It seems like so. This is one of the background, but so currently. We don't think that this is really the sign of any full recovery after this hour, so that it's still too early to make any kind of conclusion of that. So that we really carefully watch it. Still, it's quite uncertain and foreseeable when it comes to the business in China, and particularly so this is for this it have the impact over the both of our business, but particularly for that, I'd like to ask the comments from Frank-san and for the GIS.
Sorry, yes, did you ask me to comment?
Yeah, if you have.
Yeah, the audio was gone for a second. The recovery which we were expecting already in the second half of last year was delayed, as we all noticed. And the last quarter of the last fiscal year showed that we were, for the first time, seeing a positive trend. But if you compare that to 2 years ago, we are still not in a very positive momentum. So we are predicting that for the next fiscal year, we are going to see a recovery that will slowly continue to evolve, but will only show full effect in the second half of the year, which will coincide also with our efforts to start launching locally manufactured products, which is one of the factors that is typically influencing our ability to win tenders at the moment.
Okay, thank you very much. Okay, so I have the one and the follow-up questions. So how did you just, what kind of assumption you have for this, you're planning and the business in China? It seems like that we expect about the gradual recovery this fiscal year. But for example, that what happens with your new products launch or the last fiscal year, but this downside and the business in China have led to some kind of a downward revision of a business plan. So that's why you tended to be a little more conservative than last year or something like that.
Yeah, yes, that's correct. We are currently working on the assumption that we will be able to grow compared to FY25 in the lower single-digit range, which is less optimistic than we used to be. Obviously, China was one of our double-digit percentage growth drivers for many, many years, but we are expecting recovery now. But with the local manufacturing, the continued anti-fraud campaign, and the other influencing factors, we believe low single digit is the right number for us at the moment.
Okay, thank you very much. That's all for me. Thank you.
Thank you very much. To your first question, I think the COGS related, the impact of the improvement in China, I think you mentioned that. So do you still want the answer to that? Yes, if possible. Sorry, I forgot to answer that. Of course, China as a whole, the gross margin rate, there's a major contribution globally. So as it recovers, we are seeing the improvement. But because of that, overall gross margin improving, we have not seen such impact. There are other factors, and because of the composite of those factors, we are seeing the improvements. Thank you very much. Thank you very much. Thank you very much. About R&D, so about 20 billion in terms of profit and loss, it's increased. So the headcount is not quickly increasing. So how would you be spending that? So could you explain the background for increasing the R&D budget? How do you plan to use this increased part of the R&D? About the specific breakdown, we don't disclose that, but major ones. So, for example, the endoscopy, next generation endoscopy. Right now, as we say, the competition is intensifying. So, to recover our competitiveness, we need to enhance our competitiveness. So, from now on, digital or robotics, the new technologies need to be worked on. As for the single use, yes, we need to develop that. So we would need R&D budget for that. So I cannot give you the breakdown, but those are the areas that we expect to work on. But the consigned R&D and, for example, 20 billion is used for the R&D outside of the company, or R&D, the consigned R&D budget would also increase, yes. we do expect that to increase the R&D that is outsourced to outside. So I think that you have been working on the R&D on your own, but that's no longer sufficient. So you'll be using money for the outside capabilities so that you can improve the competitiveness. Well, we are not saying that our competitiveness is weakening. We need to have more options, I think. So we are not sticking with doing the R&D on our own. Thank you.
My first question is about this is a gross profit margin. It's 70.8%, 70.8%. So the Izumi-san, so that I'd like to discuss with you about the accuracy of this forecast. In the Q3, yes, your endoscopy business in China would decline, so that's why you made that downward revision. Okay, so other than that, and endoscopy and in China, the other part of the business did not have any impact on the gross profit. But so that I think that this number it cannot be explained only by this, just by the declining and the China and the rebound in the China in the Q4. So also what happens in the Q4 and including this gross profit, and it seems like you tend to be really conservative, because and also there will be some of the factors in this fiscal year. What is that this upside, expected upside in the Q4? What is that the reason? Would you be more specific about it, and what do you think about the factors in the next fiscal year? Okay, yes, in Q4. So then the two specific factors for COGS. First one is that's for the reversal of the 3.6 billion yen of that recall of that provisions, and also for the 2.2 billion yen for the suppliers. And so these are the two, and one time and the impact. So that as of the February, we have some kind of a possibility of that. By the end of March, it can be realized, and by the end of March, it was not we're not for sure, but 100% we recognize it. That's why our forecast as of the February, well, say conservative. But these two factors are that one-off. So that's why I did not have in this fiscal year. So that other than that, so for that, when it comes to accuracy of the COGS forecast, yes, we have some of the challenges to make it all the more accurate. About that, the sales did not change so much, but so the scope have changed a lot, right? So that is not that. Okay, understood. Okay, then when it comes to the next fiscal year, so when it comes to this is about increase of R&D is much too substantial. Yes, for the new developing next generation endoscopy, but sometimes sometime in the future will capitalize that. So that's why I think that's what my question is about. You mentioned about robotics is also part of it. So this is you also consider about some of the possibility of M&A, because you make a lot of investments to the innovation ventures. So taking all this not only for the organic but also for the M&A, you have increased that the level of R&D costs, right? When it comes to the M&A, yes, we are interested in that M&A for the growth, but it's not the part of the R&D. It's a separate. Okay, understood. Okay, so this is only for the organic R&D efforts, right? Yes, you're right. But when it comes to AI and robotics, and these topics are concerned, I'm sorry that I could not explain so clearly, but it's not that all of these innovative technology can be done in-house alone, but also for that the alliance or the outsourcing or the diverse for the way we're thinking about for the R&D. I'm sorry. Oh, you have a quite ODM for the AI, and also for you having the alliance with the other partners. That's why I cannot understand why do you need this kind of increase this year. If you have just getting on the new area like robotics, I understand it. What happens? It's not the news, the topic, rather EVIS X now currently is already matured and technology. So getting into the next generation of the endoscopy developments, and also for the including them in digitalizations and new manufacturing approach that are all included here in the R&D. Okay, so this is Takeuchi speaking. So Mori-san's and Nomura Securities questions, and they have also, and that's related to his question, but. And when it comes to that, how to spend these expenses and costs. So for endolumino and we have the challenges in the future, so that we need to increase the investment for that. That might be also possible, but also if we make that investments, so this is the R&D and by our organic and internal R&D or that outsourcing. So we have both. So in the sense that. And also, the question from the Mori-san was that, is that an outsourcing cost? And that will include in the R&D or that our internal or organic efforts? That was a question from Mori-san, but we included both. So anyway, this is when it comes to our competency, and we need for that, and we need to make that kind of additional and nominal and investment, but we needed to have another exploring the new areas. That's why we need to make some kind of strategic investments. So that this is that about the broader definition of R&D activities. It's very difficult to elaborate and specify that what we'll do, but all these elements are included in R&D. We hope that you understand that. Okay, understood. Thank you very much.
Thank you for the opportunity. First time asking questions. So I just want to ask you something about your China situation again. So you mentioned that the competition is becoming increasingly fierce. Could you perhaps provide a little bit more details? Which competitors in which product categories? And you guys give reason for China decline, but you didn't mention volume-based procurement or pricing pressure. That's what, for example, Roche mentioned. Roche Diagnostics mentioned that in their recent results. I think you guys did mention anti-corruption. So just wanna, I think Mr. Juolowski mentioned anti-corruption. So just want to hear a little bit more about that. Yeah, thank you.
Okay, thank you, Mr. Len. I would like to ask Frank to have the initial response to your question. That if there's any additional supplemental comment can be made by Seiji, which is for the TSD area.
I think when we look at the impact, we cut our product portfolio basically in two pieces. One is the capital goods, and the other one is the disposable therapeutic products like GI endotherapy. Typically, the value-based procurement hits the GI ET disposable products much more than the capital goods. So that means we have also seen our GI ET business struggling over the last year. And that will continue, but the way out of that is typically innovation and launching new products, and that's what we're focusing on. On the GI capital goods, which is obviously the lion's share of our overall turnover, we have a situation where the main competitors are our standard main competitor, Fujinon, in the GI flexible endoscopy side. And we are also seeing, especially in the lower segments of the hospital market, in growing trend for local manufactured flexible endoscopes in GI. So that means at the moment we are seeing our major challenges in the low and mid segment hospitals, while on the top segment hospitals with our recent launch of the X1 platform, we are still very positively growing the market there. Maybe Seiji, if you want to comment a bit more on the GIT piece, then.
Yes, yeah. Thank you very much. The trend is exactly the same as the SIS. Last physically at TSD has the ET business under the TSD, so we pretty much sacrificed the impact by BPP program for the endotherapy business, and then for the BP program itself, and also the significant competition with local manufacturers. And then, but in case of the the SIS in this fiscal year, we still have to do some of the consumable business like surgical device, energy device. That is exactly the same situation under the PPP pressure. We gradually, the business is very much tight situations, and then capital, especially respiratory, that is exactly the same as compared with GI like Fuji and other local competitors. Segmentation wise, it's the same as the the GIS. That's my answer.
Oh, okay. If I could just quickly, a quick follow-up question about the anti-corruption. Is that still a factor in China, or is that largely over?
As I mentioned earlier, let me pick it up. We feel and see that the anti-corruption approach has moved into a more permanent anti-fraud activity. And I think that's healthy, and that's a normal good compliance standards. And therefore, we feel that is not a major new impact on our future outlook.
Okay, perfect. Yeah, thank you very much.
This is a question to the Takeuchi-san, and so this time, and effective June 1st, now you have a new CEO, and it's very good news. But now, in this selection process, and there are a lot of discussion, I think, that you had before that as a candidate to dismiss Mr. Bob White. So based on these discussions and for a corporate policy, what would be fine-tuned? What would be changed dramatically after you have this new CEO? And may have that kind of ideas, if you can disclose them. And on top of that, and after this hour, for example, there's already disclosed the midterm business plan or the corporate vision, and when are you going to update about all these policies and the plans in the future? Yes, Shimon-san, thank you very much. So far, and yes, in communication in the past, we mentioned about we considered and working on the new midterm business plan and strategy. That's why you asked that question. But now that we have the new CEO, and with this getting this timing of this new CEO, it's effective June 1st. It's very, we're very happy that we can have the CEO in this early timing. But after that, and for the new management policies or the strategies, and still we're working on that, because now still that CEO has not have joined yet as a formally. So that's why. So. Yes, we have about the old and the strategies and midterm business plans. So far, we have been working on. But anyway, we need to just renew that stuff once we have this new CEO, so that it may be likely that we're going to have a lot of good input from this new CEO and from his own unique perspective. So that's why we like to fine tune and refine the current plan and strategies, and so that we'd like to take the action as soon as possible. But when it comes to the timing, we cannot mention any specific timing that when we can do that. Okay, that's all. Thank you very much.
Already some questions were asked. So in March, at the time of the CEO meeting, in the medium term, OP margin of 10% or more, and in the long run, 25% PE was mentioned. So with the new management team, rather than OP margin, basically you would try to increase R&D and to drive the top line growth in coming 5-10 years. Is it possible for you to prioritize that? Or OP margin strategy, the priority, would you be changing that or become less important? That's my first question. And about the new CEO, I think that the term of office is about 3 years. So from now on, would that be longer? Thank you. Thank you. What about OP margin target? What to do about it, or the ideas of the investments to increase the top line, or to focus more on the growth or not? No new policy has been formulated. OP margin, we are not ready to say that we are not going for the 25 OP margin. So as of now, in order to become the global medtech company and to have a strong leadership, I think that type level of the OP margin is necessary. That's what I think as of now. What was your second question? About the term of office. About the term of office. Our CEO, every 3 years or so, we had new CEOs. I think that was your understanding, but that is not the case. Either in the past or now, Bob White, in the search process of finding a new CEO,